let's talk a little bit about private equity. We know that a lot of funds are holding assets longer. They're sitting on a tremendous amount of dry powder. What are your expectations for private equity moving into 2025?
So we think overall, private equity will actually have a higher increase in volume than corporate, somewhere around 16% year over year next year. I was just at a private equity conference in Palm Springs last week with MDs from all the top PE firms, and they're all very bullish as well. I think the reason why we haven't seen as much M&A activity in 2024 as we expected, of course, there's always a cost of capital, which is a challenge, but we see that coming down. I think there's also a belief that a lot of the B quality assets were being shopped and they were waiting for the A quality asset. There needs to be more deals being offered. You see like 10 buyers surrounding a deal now, where before you only saw a handful because there are very few assets out there. So the quality assets have to come onto the market. The bid-ask gap is still wide. It went down around 2x over the last 2 years of the average multiple across all sectors, but there still needs to be a narrowing of that gap. And we did see in a survey that we did, about 66% or 2/3 of the PE buyers say they did see the sellers come down on price. So that's a sign in the right direction.
Hello there, M&A Advisor community. This is Roger Aguinaldo, and welcome back to the M&A Advisor podcast. Since 1998, the M&A Advisor's mission is to recognize achievements, provide thought leadership, and connect professionals in mergers and acquisitions for the purpose of improving your deal-making craft and accelerating your deal flow. We are so glad you're joining us for this insightful and inspiring podcast conversation curated for mergers and acquisitions professionals. Whether you're an aspiring deal maker, a seasoned professional, or just curious about the world of mergers and acquisitions, you'll find something valuable and relevant in our podcast. Our goal is to bring you the best insights, stories, and tips from the experts who've been there and done that, so you can learn from their successes and mistakes and take your deal-making skills to the next level. But before we dive into today's episode, we have a small favor to ask you. If you enjoy listening to our podcast and find it useful, please consider following us on Spotify, Apple Podcasts, and YouTube, and subscribing to our M&A Alerts newsletter. You can find the links in the description below. This will help us reach more people like you and grow our community of M&A professionals. It will also let us know that you appreciate our work and want us to keep producing more quality content for you. Plus, you'll never miss an episode, and you'll always be in the loop with the latest trends in the M&A world to improve and accelerate your deal making. So please follow us. You are the reason we do what we do, and we couldn't do it without you. And now for today's podcast.
So our next session is going to be with the Ernst & Young team on 2025 M&A Outlook, Deal Making Regulation, and Adjusting Your Strategy for Success. This session is going to be with Mitch Berlin, Vice Chair at EY America's Strategy and Transactions, and he is going to be in conversation with Katie Johnson, Transaction Partner at Ernst & Young. Welcome.
Thank you. Hi, everyone. Thank you, Mitch.
Okay.
So just kind of kicking off, obviously uncertainty has been the greatest hurdle impacting deal making this past year. I think we saw some positive momentum the first half of the year, but in the more recent months, we've seen some softening, particularly in October in advance of the election. However, we are seeing positive signs in terms of the Fed easing, inflation stabilizing, which should be positive for deal outlook. What are you seeing in terms of deal outlook for 2025?
I think it's probably important just to set the background, because if you look at, remember 2021 was crazy, no one could take a breath. The deal market was insane. And then got for COVID because we saved 2 hours in commuting that we can put into working out with our clients. But 2022 came a 37% decrease in big deals. So deals over 100 million. 2023 came another 28% decrease. So we're starting from a really low base. 2024 will probably end somewhere between 18 and 20% year over year increase in deal volume. So that's great. Those are deals announced, not deals closed. I think what we'll see in 2025 is a continued increase overall in M&A. It's the perfect storm. You've heard the last two speakers talk about a very friendly M&A environment. Any paper you pick up, you'll hear from investment bankers, banks, et cetera, about a positive M&A environment. And maybe that's because we all want it to be. So if we wish it, it will be. But I think all the signs are there that, as you said, the cost of capital is coming down. We have a administration that is more deal friendly. We expect not as tight a rein on regulatory scrutiny when big deals do come to the FTC and DOJ. And then there's the overall business driver. Deals are in the pipeline. You and I both have clients that have big deals in the pipeline, but they've been waiting first to see what the elections outcomes were, so they can build the right risk depending on what administration went in. It's a very different risk profile that you build into your evaluation model. And there's a business imperative to do deals as well. The fastest way to transform your company is inorganically through M&A. And so the time is right. The environment is right. We expect a lot of these deals to come off the sidelines and into the spotlight.
What about in terms of just the end of the year? I think I read a stat that in 3 of the last 7 election years, December saw a big increase in M&A. Any perspective on that?
I think there could be a small bump in December. We expected a decrease in M&A activity in October as people waited for election outcome. And keep in mind, last October really spiked in terms of deal volume year over year. But we do know, just our own personal experience suggests that there's a lot of pent-up activity that's coming. Whether it comes in December or January is to be determined. But there's definitely deals in the pipeline.
Yeah,
big deals.
I completely agree, Mitch. I know in speaking with many of my clients, they have a strong pipeline. There's definitely an appetite for strategic M&A. And in our most recent survey, 40% of CEOs said that they plan to do a deal next year. So kind of moving on, obviously we talked a little bit about corporate M&A on the rise. Let's talk a little bit about private equity. We know that a lot of funds are holding assets longer. They're sitting on a tremendous amount of dry powder. What are your expectations for private equity moving into 2025?
So we think overall, private equity will actually have a higher increase in volume than corporate, somewhere around 16% year over year next year. I was just at a private equity conference in Palm Springs last week with MDs from all the top PE firms, and they're all very bullish as well. I think the reason why we haven't seen as much M&A activity in 2024 as we expected, of course, there's always a cost of capital, which is a challenge, but we see that coming down. I think there's also a belief that a lot of the B quality assets were being shopped and they were waiting for the A quality asset. There needs to be more, deals being offered. You see like 10 buyers surrounding a deal now, where before you only saw a handful because there are very few assets out there. So the quality assets have to come onto the market. The bid-ask gap is still wide. It went down around 2x over the last 2 years, the average multiple across all sectors, but there still needs to be a narrowing of that gap. And we did see in a survey that we did, about 66% or 2/3 of the PE buyers say they did see the sellers come down on price. So that's a sign in the right direction. But I do think, overall, as these assets mature, so a lot of assets acquired 5 years ago were leveraged, that debt is maturing. That debt was taken at a very low interest rate. And so they're either going to have to refinance at a rate that's probably 2.5 times higher still, even though rates are coming down, get private capital, which is more expensive, or sell it at maybe a price they don't want. They have to do the cost benefit analysis to see which is the best situation for them.
Yep, I completely agree. I know in speaking with a number of consumer Ps, they remain optimistic about the M&A landscape, paying particular attention to corporate counterparts. And we know there are many corporates that I think we would expect an increased level of non-core divestitures, strategic activity, activists, pressure. And so that will really trigger a lot more PE activity as well. Let's talk a little bit about sectors. I know 3 of the last 4 years, technology has really been leading the charge in terms of the sector that's had the most M&A activity. What's your and I know a number of companies are always looking at acquiring tech assets. What's your outlook for next year? What do you see as some of the largest sectors in terms of level of M&A activity?
Well, technology will still be the number one sector, has been for the last 3 years. It will be, it's, again, I think, 40% up year over year. The year hasn't even ended. And we're going to see a lot of technology deals being done next year as well. Last week, I spent a day with OpenAI, a day with Microsoft, just understanding how AI is impacting different sectors. And there's not a sector that's not touched by AI. So that's the big driver around why these tech deals are so hot, because it's not necessarily tech buying tech, which there's still a lot of that. It's non-tech buying tech to modernize their front office, middle office, back office, have better customer experiences on the front end, more efficient operations on the back end. And so you're going to continue to see a lot of technology deals. Another sector that's going to be active is life sciences. There were a lot of life sciences divestitures over the last 2 years. We worked on most of them, so we know that those balance sheets are flushed with cash. So life sciences have an incredible opportunity to repopulate their R&D pipeline through M&A. So we expect to see that, and they don't really have to worry about the cost of capital because they have cash sitting on the balance sheet and high stock value if they want to do a cash stock deal. And then oil and gas. I mean, you heard our last panelist talk about the oil and gas sector. It's really been on fire the last 2 years. And with this new administration coming in that's very fossil fuel friendly, we expect a lot of oil and gas deals, particularly around shale assets. We think that will continue. And we know from the clients that we're speaking to, they have a lot of deals in the hopper. Some of them are divestitures. So some gas companies divesting some of their non-core assets to be able to make acquisitions around more of the core assets, but also to diversify their supplier base as well because of some of the geopolitical concerns. So lots of activity in oil and gas. But consumer is your sector. We're seeing a lot going on in consumer as well. What are your thoughts from the
Yep,
consumer
I was
perspective?
actually just going to say you left out my favorite
Yeah.
sector, consumer products and retail. So from a consumer products perspective, I think we saw a little bit of a slower start to the year, but really in the last quarter we've seen quite a surge in activity. One of the largest deals of the year with Mars acquiring Kellanova happened during this last quarter, and I think we would expect to see more packaged foods transactions coming off the back of that transaction. So particularly as companies are looking to diversify their portfolios and invest in higher growth snacking assets. It's been a little bit quieter in terms of the broader household and personal care, and I think we would expect a pickup in HPC, particularly in beauty. Um, and I think from a retail perspective, I think consolidation is really going to continue to be the driver in terms of M&A. We heard the panelists previously talking a little bit about Kroger Albertsons, and so we're very interested to see the outcome of that transaction.
You also have a lot of new consumer health companies out there. They're going to have
Yes.
to acquire to scale up that were the result of a couple divestitures last year. And then, brand divestitures, I'm guessing will pick up as well as the market becomes more favorable.
Completely agree. I think we're seeing we're talking with a lot of our clients, and this is the timing in terms of when they're going through their strategic portfolio reviews. And consumer products portfolio is always the play. They're always going to be looking at their portfolio both on the acquisition and divestiture side. So Mitch, let's talk a little bit about alternatives to growth in terms of M&A. What are some of the newer ways that you're helping CEOs transform their businesses?
So you have inorganic growth, which is through M&A, but we do see a lot of our clients starting corporate venture capital funds and figuring it out how to do better at organic growth. So this comes in a couple of ways. One is through trying to identify what new P&Ls that they can move into. And so most of these organizations are sitting on some sort of unique endowment or asset that they're not fully exploiting. So you can have customer databases, you can have retail proximity. So if you take something like a Walgreens, for example, I'm making up the calculation, but you'll get the sense. I'm sure there's a Walgreens within 5 miles of 80% of the United States population, right? what are they doing? That's an endowment, an asset that they haven't fully exploited outside of, you know, drug and consumer products and maybe some healthcare clinics within. There's probably something else there that they can do with that unique asset. So we're really working with our clients to understand what are their unique assets. Are there ways that they can create new P&Ls that can add billions in market cap at the end of the day and maybe help hedge against other markets that they're in? So can a consumer products company become a technology company? Can a distribution logistics company become a construction company? Can a financial services organization become a social commerce organization? So it's really looking at different P&Ls that they can create using their own assets. The other thing that we're discussing with our clients is really understanding the total cost of an asset and the life of that asset. So, for example, when an industrial product leaves the building of the manufacturer, maybe only 30 to 40% of the true cost that that asset will incur in its life is being the organization that's selling it is the beneficiary of that. So who owns the other 60% of that, and how can you actually bring some of that in-house? So if you take something simple as a tractor, you have insurance, you know, oil and gas, maintenance, tires, batteries, all those other things that other people are benefiting from. How do you bring that in-house, and how can you benefit from that as well? Like maybe perhaps a captive insurance company. So we're working with companies around that to understand how can they attach on to the things that they're selling and be more earn a greater part of that overall value chain.
Yeah, it's very interesting, and I definitely am seeing that we're gaining traction in these discussions as companies are looking at digital engagement. They're looking at new business models from a channel perspective. They're looking at uses of data, and so really interested to see. Do you expect to continue to see venture building as a key driver moving into next year as
We
well?
do. A survey that we did a couple months ago showed that the average corporation is adding about 60% to their internal venture capital fund.
Great, thank you. Um, so next question. How are geopolitical risks, such as trade tensions and political instability, impacting CEO confidence? And how can companies mitigate these risks?
Yeah, we heard a little bit about that earlier today. You know, you have you know, a war in the Middle East, a war in Ukraine, perhaps a trade war with China coming up, and so it's really working to understand where you're going to see risk and stress in the system across all parts of your organization. So you really have to dissect everything your organization does and understand how this impacts it. And you have to go beyond the 1 or 2 degrees of separation to really understand the 6 degrees of separation, because you may have a product that may not come directly to you from China, but perhaps parts of it are comprised of things that are manufactured in China or do pass through China, for example, for production. And so you really have to understand every part of the value chain, where it exists, and is that level of risk acceptable and tolerable? And if not, how do you mitigate it now? And if it is, what is a potential mitigation plan in the future? And understand, do you want to be proactive or reactive on that? And so we are working with our clients to go through their vendor databases to really understand the full manufacturing ecosystem, not just what they manufacture, but where the components come from, the raw materials, as well as the manufacturing for that, to come up with a holistic risk assessment that takes into account the geopolitical risk. I mean, it can even be things, as much as like building up working capital. If physical trade flows are disrupted, how do you build up working capital if something now takes 4 weeks that used to take 2 weeks to land in your warehouse? So it permeates throughout your entire organization.
Yep. Yes. I don't think there's any anticipation that these risks are going away. So focus on the mitigation strategies definitely makes sense. So Mitch, we're almost out of time, and I noticed a trend in the prior two panels in terms of asking if their Trump story. So do you have a Trump story?
I have no Trump story. The closest I've come to Trump is the Gucci store on 56th Street. So I knowing that he was above me.
Okay.
So that's it.
Okay.
But I do think it's going to be an interesting 4 years for M&A. I do think there's a lot of excitement about the loosening, of the regulatory environment. The capital markets certainly have rallied, and that's a great sign. And when you talk, whether it's private equity, corporate investment bankers, people are very bullish on 2025, and we're all expecting a very active year for all of us in this room that make their living in M&A.
I completely agree. Well, thank you, Mitch.
Thanks, Katie.
Thank you.
We hope you enjoyed this episode and learned something new from it. If you have any questions or comments for us or any of our guests, please feel free to leave them in the podcast platform of your choice or send us an email at editor@maadvisor.com. We would love to hear from you and get your feedback. And if you haven't done so already, please follow us on Spotify, Apple Podcasts, YouTube, and subscribe to our M&A Alerts newsletter at the links in the description or on our website at www.maadvisor.com. This will help you stay updated on the latest M&A interviews and trends and support our podcast to grow and reach more listeners like you. This is Roger Aguinaldo, the creator and founder of the M&A Advisor. Thank you for tuning in and being part of our M&A Advisor community. Until next time, stay safe and happy dealing.